Hi, and welcome to Jankin's Guard on Risk, the YouTube channel dedicated to the theory and practice of risk management. Now, leverage is a very important indicator of corporate risk, but there's a veritable jungle out there in terms of different leverage measures on offer. So we're going to see if we can sort that out and try to establish what is really the best way to measure leverage. All right, so please find more about leverage risk in my book, Empowered Enterprise Risk Management, co-authored with Petter Kapstad. There's also more information on my webpage, riskbudgeting.se. And as they say here on YouTube, please like and subscribe. All right, in very broad terms, leverage refers to the use of borrowed money, the purpose of which is usually to enhance investment returns. And we're going to be interested in leverage because it contributes to risk. And the flip side of leverage is solvency, which is understood as the possession of assets in excess of liabilities or the ability to pay your debt. All right, so we want a measure of leverage that captures the idea of using borrowed money to enhance investment returns, but also produces a higher risk profile. So we want to be able to compare a sample of firms, let's say, which is the more risky of these firms in as far as the use of borrowed funds is concerned. And we also want to establish or measure how risk changes over time. So how the leverage measure develops over time is going to be of interest to us. And we also want to maybe incorporate some measure of leverage into our risk model. You know, if we are developing a decision support tool for corporate risk management to support decision making in that area, we're quite likely to want to include some measure of leverage in that context to as part of a broader effort to manage risk and return in companies, right? So for all these reasons, we would like to have a useful measure of leverage to be able to apply them. But as mentioned, there are plenty of them. We'll start with the most straightforward of them all. So if we have some numbers over here, we have assets financed in equal parts by debt and equity. And the most straightforward way to capture leverage would be to just take debt as a proportion of assets. I will refer to this as the classic leverage measure. So if we do that, we take 500 then, which is debt, through assets. So we get a 50% leverage here. So moving on, we can choose to do this a bit differently here. We first calculate the leverage as before, but we're going to consider something referred to as the leverage ratio, which is assets through equity. So we use the same numbers, except a little bit differently. We rearrange the equation a little bit so that assets is now in the numerator and equity in the denominator. So that gives us a value of 2, which is obviously a different kind of magnitude than the 50% classic leverage. Now, the leverage ratio is mostly used in the context of US financial institutions. When Lehman Brothers went bust in the most recent financial crisis, then it was sometimes commented on in the press that their leverage ratio was, or the leverage was in the neighborhood of 30. Then they have this measure in mind. That was, the leverage ratio. Then that was what they were using to make that assessment. And it's important to see that because it would have a completely different meaning if leverage was defined in a different way, right? So moving on, leverage, the classic version of it as before. Now we're going to consider something called gearing. This is when we relate debt to equity rather than assets. So it's just, again, the same numbers, rearranged one more time. So expressed this way, the gearing is 100%, debt as a percentage of equity. Right, so we already have three, but this just goes on, as we shall see, and I'm not going to cover it here, but other measures of leverage include interest coverage, where you would take some measure of operating profits here through the interest payments. So how many times over could you cover your interest payments, basically? That's another way to describe the use of borrowed funds, leverage in that broad sense. So yeah, lots of them. But we'll continue to use stock variables here and see if we can establish which is the better way to do this. And it all depends on the context, of course, what you're looking for. But we're going to tease out some pros and cons here. All right, so if we compare leverage and gearing, this is the classic measure of leverage. Then here the financing changes. Initially, it's 100 in debt financing out of the 1,000. I mean, the asset base is 1,000 here for across this spectrum. So as we increase the debt usage here, so here debt is 9 times equity. So you have 1 unit of equity for 9 units of debt. In these cases of very high levels of debt, then the gearing measure kind of explodes. So it's just a feature of that way of defining leverage, right? So that makes it somewhat problematic in some applications. It doesn't necessarily correspond to an increase in risk of that magnitude either. So given these extreme values that you sometimes get, you have a problem with estimating statistical models, let's say, that involve these ratios. So this nonlinearity can be a problem in that context, and many analysts and academics prefer the classic well-behaved leverage ratio, leverage measure, for that very reason. But it's not like nonlinearities go away just because you use leverage. It seems like a nice linear increase here, but there are substantial nonlinearities in that measure in this end of the spectrum instead. So leverage is a bit elusive in that sense, that you can get very large increases for a change in absolute magnitudes that doesn't imply a very, very large shift in risk. So we have to keep these caveats in mind here. But here's one thing to keep in mind when choosing between different ways of calculating leverage, right? That classic leverage tends to stay more well-behaved across a range of possible outcomes, right? All right, so let's introduce a bit more realism into this calculations. So we're going to look at trade, meaning we have now payables and receivables as part of the picture. So in this case, they are equally large, so whatever you're selling on credit, you're getting the same benefit from buying on credit. So effectively self-financing then. So we're going to look at a different measure of leverage then, which is total liabilities to total assets, which is not possible because we have liabilities that are not strictly speaking debt, right? But those two put together will be total liabilities if you add trade payables to debt. So maybe we're capturing something important here in terms of risk. Let's think about that. Well, first of all, if you compute the liabilities to assets ratio, it's 60% here now. Here we're introducing a very similar firm, except that trade receivables is now 300 and payables is also 300. So again, balancing out, self-financing nicely there. If we compute the total liabilities, in this case, it's a larger number than before. So liabilities to assets would go up 64% now. signaling an increase in risk. But is that very accurate? Because the self-financing they still balance, right? So there's not much reason to think that this firm is a lot more risky than this one here. But the liabilities to assets ratio does indicate higher risk, which is questionable then. And you might find that the liabilities to assets exaggerate sometimes the risk profile of firms with larger operating liabilities, or at least there's a potential for that kind of conclusion using that measure, since working capital can be sort of evenly trade receivables and trade payables can very well be of equal magnitude, right? So we don't necessarily have a lot of reasons to worry. All right, let's continue. We're going to introduce a pension liability now in the balance sheet. So on the asset side, we have property, plant, and equipment. We have debt, equity, and this pension liability then on the liability side. So we're going to look at something called debt and equivalence to total assets. Debt and equivalence refers to the fact that many liabilities are like debt. They behave like debt in important respects. For example, if you're not able to meet your pension liability, you're liable to be sent into administration because it's a legal thing. It's a legal contractual obligations in the same way as your creditors would send you into bankruptcy if you fail to meet those obligations, right? So since it's pretty much the same from a risk point of view as debt, we're going to consider debt for these leverage calculations. So first, see here what happens if we apply the classic leverage measure here. So it indicates 38%. The numbers change somewhat because we modify the assumptions. So it's not directly comparable necessarily to the numbers we had before. That doesn't matter. All right, so debt and equivalence, on the other hand, is 500 now, compared to debt as a standalone number 300. So we're adding the pension liability to debt to get this number, right? So debt and equivalence to assets is 63%. Compare that with a situation in which the firm has zero pension liabilities, but higher debt. So from a risk point of view, maybe those are largely equivalent, right? Because it's the same kind of legal obligation we're facing. In some cases, you see firms raising debt to finance sort of a cancellation of the pension liability. They use the borrowed funds to pay down the pension liability to they pay some fund manager to take that liability off their hands, but they now have debt instead on the balance sheet. So General Motors did that at one point, for example. So swapping one liability for another shouldn't do much in terms of the risk profile, right? But the classic leverage measure does signal that because it ignores the debt equivalence. So there's a fairly massive increase here in leverage, according to that measure. Whereas if we're using debt and equivalence and the debt and equivalence to assets ratio, we're not tripped up by that. We see through that and we realize that debts and these pension liabilities are largely equivalent. So this measure picks up on that, which is an advantage then. So another conclusion is that the classic leverage measure understates the risk profile of firms with large debt equivalents. So there's a chance to improve things somewhat by using debt and equivalence rather in the numerator. All right, moving on. Another real-world complication is the existence of large cash positions in some firms, which has an obvious offsetting effect on the risk profile, right? If you have cash, you could view that as negative debt in a way, in the sense that you could turn around and use some of that cash to pay down the bank the next day, if you were so inclined, right? So this risk dampening effect of cash can be incorporated in the measure. And for that purpose, we net the cash position from gross debt, so that we take debt net of cash, essentially, net debt, that is referred to. As we do that, it's important to see that the definition of assets changes as well. It's like algebra. We're going to move cash over to this side because we're going to net it against debt here. So shifting that over here, it changes sign, right? But then only PP&E is left on this side. So the total asset is no longer relevant for that calculation. So net debt, first of all, is the pre-existing debt here, which we then subtract cash from to arrive at net debt, 350. That in relation to net assets is 44% then. Compare that to an otherwise similar firm that doesn't have any cash on its balance sheet right now. So you'd expect that to be a riskier firm, right? If they don't have any cash around as a buffer, well, that tells us there's more risk involved. So with the net debt measure, in this case, well, it's 400, right? I mean, the numbers again change because there's there are fewer assets to finance, to put it that way. But anyway, so the debt appears here, but there's no cash to net out. So net debt is 400. And we relate that to net assets, which turns out to be the same number, 800, just the PP&E in this case. So this measure of leverage signals higher risk in this firm. And this is in agreement with our intuitive assessment, right? We quickly realize that having no cash means more risk, right? So this definition seems to do a good job of telling us about that. So we're going to perhaps prefer that. The conclusion would be that netting out cash increases information value with respect to default risk. We need to remember to subtract cash from assets as well. All right, so in this case, we're going to add yet more realism. We have inventories now as part of net working capital. And we're finding that trade payables doesn't quite reach a point where it's sufficient to finance these two, the operating capital here. So there's a bit of a gap now. Trade receivables plus inventory less trade payables, that's net working capital. And in this case, it's a positive number. So that implies a financing need. We have to come up with external funds to close this gap. And that's often done through the use of some short-term debt. You go to the bank and ask for some short-term funds to take care of your short-term borrowing needs. And yeah, so if you get that, then that will be in your balance sheet to sort of close the balance sheet, and the whole thing balances. All right, so this meaning that we have two things that require financing now. So what needs to be externally funded is something we refer to as invested capital. We need to raise money to cover not only the fixed assets here, the PP&E, but also this net working capital. So leverage is going to be relevant to consider in that context, right, in relation to this invested capital, because everything else is sort of covered by operating liabilities. So a portion of the working capital here is financed by trade payables. So that is doesn't introduce a financing need. So we leave that out of this definition here of invested capital. So invested capital should then replace total assets in the denominator. That's the only thing that requires external financing, and the use of borrowed money to enhance investment returns is basically only relevant in that context. So we have what we might consider then an improved measure of the denominator in the leverage formula. We put that together with what we argued previously is a more informative measure of the numerator. So denominator investor capital and numerator net debt and equivalence to IC. So we do two things here. We consider the debt equivalents because those are like debt and they are in a real sense adding to risk. So we will be interested in those. We do net cash out because cash is a buffer against risk and could potentially be used to repay loans, right? So using the numbers in the example, we can calculate net debt as the two different forms of debt here, the equivalence to debt, pension liability, and we use the cash to, we net the cash out to consider the risk reducing effect of that. So net debt and equivalence is 600. So computing the net debt and equivalence to investor capital ratio gives us 63% here. And that would be considered a maximum correctness from a theoretical point of view. We're considering various aspects of the risk profile that most people would agree are real. So we get maximum informativeness about risk and comparability across firms, because that takes care of various ways in which firms systematically differ from each other and puts them on a comparable basis, right? But there's more complexity involved, more steps, more calculations. Maybe most of the time something simple will do, like the classic debt to assets leverage measure. But that's up to all of us to decide, how far we're willing to take this. But all right, so some conclusions. Leverage at the most basic level is the use of borrowed money to enhance investment returns. And you could straightforwardly calculate it as debt as a proportion of total assets. You can, in various ways, then, as we've seen, improve the comparability and informativeness by considering aspects of the firm's balance sheet that either increase or decrease risk, like cash or debt equivalents. So if you want to use a theoretically very correct version of leverage, it would include debt equivalent and it would net out cash and put that in relation to invested capital. But also remember that if you're doing risk modeling, in the context of a corporate decision support tool for risk management, you might want to consider modeling cash and cash and leverage separately, so that you're able to predict and simulate cash independent of any leverage sort of definition and have a more dynamic analysis of risk than this static measure. But that being said, this would be our winner or favorite in terms of comparability and risk informativeness. So, all right, that concludes. Please check out my books, Corporate Foreign Exchange Risk Management and Empowered Enterprise Risk Management. Also find information on my webpage, riskbalancing.se. And as always, please like and subscribe. Thank you very much and have a good day.